So in today's video, we're going to look at the differences between futures and options trading. By the time you finish this video, you're going to have a better understanding of how these derivative instruments work and which one might be suitable for you. So let's define what they are. Futures are just contracts. They obligate a buyer and a seller to transact an asset at a predetermined future date and price according to the contract. Options, on the other hand, give the buyer the right, but not the obligation, to buy or sell an underlying asset at specific price and date. Now, this is why they're called derivatives, because you're trading an underlying asset with a futures contract or an options contract. So one of the biggest differences between futures and options is the level of leverage and risk. Futures, these are known for their high leverage. That means a small price movement can lead to a substantial gain or a substantial loss. So leverage does amplify profits, but it also comes with increased risk. So let's say you're bullish on crude oil and you think that prices are going to rise in the near future. So you trade future oil contracts. These are just standardized contracts to buy or sell a specific amount of crude oil at a predetermined price and date. So each crude oil futures contract on the NYMEX represents 1,000 barrels of oil. So let's assume that the current price of a crude oil futures contract is $60 a barrel. And the initial margin that's required by the exchange is 10% of the contract value. So to control one contract, you need to deposit an initial margin of $6,000. So this means that you now control $60,000 worth of crude oil with just $6,000. That's 10-to-1 leverage. Talking about risk, here's the problem. So let's imagine the price of crude drops to $55 a barrel. Well, the value of your contract is now $55,000. So your loss will be $5,000. That's the $60,000 minus the $55,000. This is an 83.33% loss on your initial investment of $6,000. So options is going to limit the buyer's risk to whatever they paid up front. Let's say you buy a call option for $100 and the trade does not go your way. Well, your maximum loss is a $100 premium. That's it. With futures, your losses can potentially exceed your initial investment and you get hit with a margin call. That's not going to happen in options. So another key difference is how you profit. So with futures, you can only profit when the market moves in the direction of your trade. So if you're long a futures contract and the price goes up, you're going to make money. If it goes down, you lose money. It's that simple. Options are going to give you more flexibility. So you can profit from various market scenarios, including up movements, down movements, even sideways price movements. It just depends on the strategy you were using. Buying calls, buying puts, creating spreads. Let's say you want to trade options on ABC stock. It's currently trading at $50. Well, you have a neutral outlook on the stock, meaning you don't think it's going to go up a whole lot. You don't think it's going to go down a whole lot in the near term. So to take advantage of this, you use what we call a short straddle. So you're going to sell a call option and sell a put option with the same strike price and expiration date. For example, you could sell a $50 call option and a $50 put option. Both expire in 1 month. So by doing this, you now collect premiums from both options up front. So the buyer of those options is going to pay you money. So if ABC stock remains stable and it closes around $50 at expiration, both options will expire worthless. You probably get to keep all the premiums as profit. So how do you choose between futures and options? Well, it's going to depend on your risk tolerance, your trading style, your goals. If you're comfortable with higher risk and you want to seek out potentially larger returns, maybe futures is where you want to head. But if you want a bit more conservative approach, you have some defined risk, options could be the way to go. Whichever one you use, you got to educate yourself on how they work, understand the risks, and of course have a solid trading plan before you head into these. But also consider factors like your account size, which markets you're going to trade, and your overall objectives as a trader or an investor. So to succeed in this, listen, here's some tips to keep in mind. You got to educate yourself. You got to learn about the markets, understand how they work, what factors influence the pricing, and make sure you find a trading strategy. Start small. Begin with smaller positions to get your experience, build up confidence before you increase your trade size. Risk management, always have a plan for managing your risk. That includes setting your stop loss, taking profits at certain levels. The biggest one, stay disciplined. Stick to your trading plan. Avoid those impulsive decisions. Hey, we've all made them, right? We're only human. We just want to not make as many. Keep learning. Always expand your knowledge. Stay updated with how the market's moving, some news, learn from your successes and failures, and that's the key. When you win, learn from it. When you lose, learn from it. And not just what you did, how you felt, how you manage your emotions, all those kind of things. They're all important. So to wrap it up, futures and options, they are both pretty powerful trading instruments. They have their own unique characteristics. They have their own risks, their own rewards. You just have to understand the differences between them and align your trading approach with the goals that you have and the risk tolerance you have. And finding out more information about options trading, it's zero risk for that. So I want you to feel free to reach out to our in-house options specialist. His name's Mike, really great guy. His email, mike@netpicks.com with any options trading questions you have. We'll talk to you soon.